So in this video, we'll be showing you clips from 5 different videos from our pre-scene analysis pack. And the first clip is from the pre-scene analysis series. It's vital that you fully analyze your pre-scene, and this requires a detailed examination of the case study, ensuring that every section is fully understood. So our pre-scene analysis video provides a page-by-page analysis of every section of the pre-scene, and it ensures you don't miss anything important, and it helps you to build a comprehensive understanding of the material. And this is vital if you're going to gain high marks in the exam. So in this clip, we've taken a section from our pre-scene analysis video series.
So there's your role. Let's move on now to have a look at the company background and pick up on information and some analysis that is going to help you as you go into the exam. So the company that we are dealing with is called Halfpenny, and it's a company that produces and sells packaged bread. So right from the outset, we can know that this is not a small bakery. It's because it's selling packaged bread. This isn't an artisan bakery. It's a mass production model, really. And so it's not just any bakery. It's everything is about scale. Everything's about efficiency. Everything is going to be about shelf life. So this is very different to a small artisan bakery. This is going to be a large scale operation, and so we're going to need to bear those kind of things in mind, because there are certain costing implications, there are certain risk implications when it comes to this particular business model. And so maybe part of what you might need to do in the exam is to answer questions about how the business model can affect things like decision making and risk management. But we're talking about a mass production model. So there's going to be presumably things like workshops available, lots of equipment, a lot of things that would not be relevant in a smaller context. Now, we know that this company is based in Kieland, so it's a fictive country, but we are told that it's a small country in Europe, and that the currency is the K dollar. So what we've got here is a small domestic market. It's a small country. And so that has important implications, because a smaller market could mean that there are limited growth opportunities. It could make it, in a sense, difficult to expand. And so that's going to be a key strategic consideration, really, the size of the country. Perhaps another thing to bear in mind as well is the use of the K dollar. That there's some potential exposure to exchange rate risks going on there. So if the company imports raw materials from abroad, that's going to be something that needs to be considered. Also, the economic conditions in a small country, that's going to be something that sometimes is more volatile, and so there may need to be some risk assessment going on there. Halfpenny might need to be strategic with its cost control and its pricing. So you're going to really want to have perhaps your financial reporting hat on when it comes to foreign exchange and market risks at this point. So we've got a bit of a history of the company. The company was founded in 1891. So it's quite an old company, and it's well, initially, obviously, it was a family-owned business. It had a single small bakery store, but there's some expansion that happens. And so we've got a bit of a history of that expansion. It expands to 3 bakery stores still, it seems, selling out of the bakeries, and they're all within a 20-kilometer radius of the first. So it's within a small area. And then in 1916, the production of bread is moved to a single purpose built bakery. So there's a bit of a shift that goes on. The company grows in the 1920s and 30s, and then by 1940 it had expanded to a number of stores, so still selling out of their own stores. Now the key point here really for this paragraph in terms of the history is this is an old company. And in a sense, that the heritage of an old company can build a real sense of trust. And so it gives it a well-established brand reputation. This is an old company. Now, that can be a real advantage in an industry where trust is really important, when that can influence consumer buying decisions. And so a company that's been over for a century can can be seen as reliable and high quality. But that said, just being old, just having longevity isn't enough. So the brand is going to need to stay relevant in the modern world. Now that might involve evolving for customer preferences. And so if Halfpenny ends up leaning too much on its heritage without ending up adapting its product range to the modern world, what could happen is, rather than the advantages of the heritage side of things happening, is actually it just ends up being seen as outdated. Now, it may be exam-wise, it may be that you are asked a question perhaps related to E1 when it comes to KPIs. What kind of KPIs should Halfpenny use to track and to measure its long-term business success? This is a business that's been around for a while. What kind of KPIs can help to track that success? So there's a bit of an early history of Halfpenny. But then there's a strategic shift that happens. So 1948, we've got Halfpenny, again, a descendant of the Halfpennys, a grandson of Martha and Bert. So it's still family business. He becomes managing director and majority shareholder of the company. And there's a shift that happens. There's a significant change in the company. And that change is that by 1952, the company no longer has its own stores. Instead, the company becomes entirely focused on the production of bread, which is then sold to grocery stores in central Keelan. So we've got a shift from their own bakeries where they sell their own stuff to wholesale. And there can be some efficiency around that, but then they also need to rely on various retailers. So there's a shift in business model in the decades that come. And so basically the company shifts in to go to a B2B, business to business wholesale model. And so that makes Halfpenny highly dependent on retailer relationships. Now that can be a strength and a risk, and it may be that you are needing to assess some of those strengths and risks in the exam. Part of the idea is if a supermarket demand ends up dropping, or if competitors offer better terms to those supermarkets, the business ends up having limited alternative sales channels. And so the fact that this shift happens so early, it suggests that operational efficiency has always been at the core of Halfpenny's strategy. So there's an early shift to go to a B2B model. Now there's another shift that happens. So until 1952, all of the bread sold by Halfpenny was unsliced and unpackaged. But then there's a change. In 1952, Joseph invested in what was, at the time, it was state-of-the-art machinery in order to slice and package loaves. And those loaves are packaged in Halfpenny branded waxed paper. Now, this is an early adoption of automation. And so that suggests that what goes on is very early on, the company is positioning itself as a leader in efficiency and mass market appeal. And also the branded packaging that can help establish brand visibility. And this is happening in the 1950s. So this is a very early adoption of this kind of mass scale automation. And so the fact that this came more than 70 years ago shows that the company has a history of thinking forward in terms of investment and technology. And that's going to be something that's important as the industry continues to evolve, especially with an emphasis on sustainability and so on and so on. So with your P1 hat on when it comes to costing and investment appraisal, perhaps the part of what you might need to do in the exam is to think through whether there's a case for Halfpenny investing in further automation to improve its costing and efficiency, and how you would go about justifying and supporting that kind of decision. Now, there are some other innovations that are going on at the same time. So that innovation coincided with advancements in the ingredients that are used in bread production. And the advancement in these ingredients, the key thing is that it extends the shelf life of a bread loaf. And that is a major advance for A product that has a short shelf life, to be able to extend that is great. It's essential for large scale retail, really. So longer lasting bread means you can have more distribution possibilities. You can have a stronger appeal for large retailers because they're going to generally, large retailers are going to prefer products that stay fresh for longer. And so that focus on shelf stability, being able to keep that product for a long time on the shelf, that's going to be key even today. And so Halfpenny's competing in a market where minimizing waste but maintaining product quality at the same time are going to be absolutely crucial. That said, there's a growing interest in fresh and artisan bread, which by its nature has a shorter shelf life. So there is a risk that is involved here. There's a risk that if you're relying on ingredients that are presumably adapted, perhaps not natural quite as much, and you're relying on that, then maybe it means that the bread you're producing and the brand ends up being less aligned with some of the modern health and sustainability trends. So if you've got your P1 hat on, thinking about risk and uncertainty, then maybe there could be an exam scenario where you are needing to think through how is it that extending the product shelf life can impact risk and could also impact forecasting.
Next up, we've got a clip from our strategic analysis. It's extremely important that you have the ability to identify how the pre-seen relates to key models and theory, and the examiners will expect students to demonstrate a good understanding of the models and theories and make the appropriate links to the case study during the exam. It can be hard to fully analyze a company using models you've only recently learned and be confident that you've got it right. So our strategic analysis has done that hard work for you. So in this clip, we're going to take a look at our strategic analysis video.
Mission is central because it really does tell you what the company is about, what they want to do. And within mission, there are several elements to mission. There's purpose, which is why the organization exists. Who does it exist for? What does the organization want to achieve? That's kind of the high level of mission. Within that, you've then got strategy. Okay, how is the organization going to achieve its purpose? How is it going to compete with the other businesses that are producing perhaps similar products? So that would be strategy. Another element of mission is values. This is more about what the company, what the organization actually stands for. So things perhaps like quality or value for money or innovation, etc. And then finally, within mission, we've also got policies. Now, policies are the internal rules of the company that make sure that people act in a way that lines up with the values, the strategy, and the purpose. So they're kind of the internal rules of the company. So when we're thinking about this from Halfpenny's point of view, what would we say Halfpenny's purpose is? Well, I think looking at the pre-scene, we could say that Halfpenny exists to provide high quality packaged bread to retailers across Keelan. I think that's a general assumption from the pre-scene, but we can be a bit more specific. It also wants to be the number one choice for packaged sliced bread in Keelan. So it's a pretty ambitious purpose, but I think that's what we could sum up as the overall purpose of Halfpenny. Now, what strategy might it have? What ways of getting there? How will it compete? Well, I think one of the ways that it's going to compete is through brand strength and reputation. Remember, they have got a real heritage, over 100 years of bread production. They are going to be able to compete through their strength of reputation that comes with that age. They're also going to compete through operational efficiency. They want to become more and more efficient. They want to control costs as much as possible. Remember, there are very small margins in their pricing, and so they're going to want to have cost control. And innovation is a key part of how they are going to compete. They want to innovate in response to market demands. And another way that they are going to compete and have a strategy is to have strong relationships with the different retailers, those different supermarkets and smaller convenience stores that they have got contracts with. If they maintain strong retailer relationships, that's going to be a strategy to become that number one choice for packaged sliced bread, and that's going to help them to compete. When it comes to values, what could we say for Halfpenny? Well, We could say, looking through the pre-scene, we could say there is a commitment to quality and consistency. So they want to have quality ingredients. They make that very clear. They want consistency. That's something that came through in the interview with Trey Halfpenny particularly. There is an emphasis on sustainability. They want to have ingredients that are done that are sustainable. They want to innovate. We've already mentioned that. That's going to be one of their real values. And they are also environmentally conscious. They want to be carbon neutral by 2040. Now, when it comes to policies, we don't have any explicit policies in the pre-scene. And so we can pretty much assume that any policies that Halfpenny has are going to be aligned with their values. So there's going to be a focus on ethical sourcing, on sustainability in the supply chain. So those are going to be some policies we can assume that Halfpenny has. So that is the mission of Halfpenny. Let's now move on to talk about some objectives and how we might measure the company's performance in terms of achieving those objectives. So you've got the mission, which is the high level stuff. How does that translate into some specific objectives? The objectives basically are focused targets that you can move towards. They are things that allow you to, so rather than just the high level strategy, you've got some very clear goals, some targets that you're able to actually move towards. Now, the great thing about key objectives is that they can motivate your staff because there's a key goal. They're not just kind of having to do their job in the abstract. There's a key goal. And it's also going to enable you to measure the performance because you've got an actual quantifiable target to hit. It's therefore much easier to get a sense of how you are doing in terms of hitting that target. Whereas if all you've got is #1 bread sales or bread retailer in Keeland, that's too high. What you need is some clear objectives that you will get and that you can measure. So bearing that in mind, what are some objectives? What are some, in this case, I think we'd call them inferred objectives because not all of the objectives are necessarily spelt out in the pre-scene, but we could infer some objectives and some of them are a bit more explicit. I think one objective we could infer is that Halfpenny wants to expand and maintain its market leadership. Obviously, ultimately, it wants to be the #1 bread choice for bread, for packaged bread. And so one of the objectives is going to clearly be to continue to expand and to maintain that market leadership. Another objective is going to be enhance operational efficiency and innovation whilst maintaining sustainability. So they are going to want to make sure that things are done as efficiently as possible. That's already something that they do really well, but they're going to want to continue to do that. But they're going to need to hold that hand in hand with their emphasis on sustainability. They want to have sustainable ingredients, and sometimes that comes with greater costs. And so they're going to have to balance out this emphasis on efficiency and innovation and then sustainability. And the two sometimes pull in different directions. So they're going to have to do that in such a way that they can achieve both. And then a very clear, this was an objective, clear target from the pre-scene. They want to achieve carbon neutrality by 2040. So those are some objectives, but how would we measure those objectives? What kind of key performance indicators, some KPIs, could we use to measure how Halfpenny is doing in terms of hitting those particular objectives? Well, here are a few that we might suggest. One of the KPIs could be market share and revenue growth. Another one could be profit margins. That gives us a real sense in terms of the financial side of things. When it comes to the more to do with sustainability, well, we might have some different KPIs at that point. It's not necessarily going to be financial ones, but they might be sustainability metrics such as carbon footprint, use of recycled materials, maybe amount of waste that is being generated, and then some other again, non-financial KPIs that might be relevant here. Things like customer satisfaction. That's not always quantifiable. It's a little bit more qualitative. And then product quality measures. So it could be feedback from customers, probably ultimately from the end consumer of their product. That will give a sense of how are Halfpenny doing? How is Halfpenny doing in terms of achieving its targets?
we're casting the net a little bit wider now with a look at the wider industry in which the pre-seen company operates with our industry analysis video. It is critical to demonstrate to the examiner that you have fully understood the pre-seen industry as a key element to gaining extra high marks in your case study exam. Researching the industry can be a laborious process, especially when you're not sure which information is useful and which isn't. And our team has spent hours doing this research for you, finding the information that will help you to achieve a wider perspective of the industry and build a deeper knowledge in preparation for your exam. So in this next clip, we'll be taking a look at our industry analysis video.
So let's start by talking about how to use this industry analysis and what to expect for it. So the idea is that in the OCS exam, you don't just want to have a good knowledge of the pre-seen, you also want to have a good knowledge of the industry that the pre-seen company is from. And so if you are then able to draw on some insights into that industry, that's really going to help you. It's going to very much link with the role that you have in the OCS exam. Just to remind you, you are meant to be working as a finance officer in the finance department of Halfpenny, which is the bread baking company that the pre-seen is about. And so you're going to need to make sure that as you are working as this finance officer, you're able to actually provide advice, business advice, as if you were actually working in that particular industry. And so that is why it's going to be really helpful for you to know the industry that you are meant to be working as part of in the exam. And so one of the ways that you can make sure that you maximize your marks, that you get as many marks as possible, is to know that industry well, make sure that you have a sound knowledge of that industry, and then to draw on that knowledge so that you're not just referring to the pre-seen, not just referring to the unseen information, but that you're also referring to the broader industry that you are meant to be part of in the exam. Now that's where we come in to help you, because what we've done is we've basically had a bit of a look around, we've scoured different journals, the web and so on, and we've put together an overview of the bread industry so that as you read through this pack, we've basically done the hard research work for you. As you read through this pack, you can become familiar with the industry that you are meant to be a finance officer in. And that's going to help you when it comes to that broader knowledge. That's going to help you when it comes to drawing on particular industry examples in the exam. So that's really what this industry analysis is about. It's helping give you that well-rounded knowledge of the industry that you are in. Well, let's jump in to look at the bread industry. We're going to cover lots of ground in this video in terms of the bread industry, whether that's the financial side of things, the marketing side, ethics, CSR, operations. But let's start with a bit of an introduction. And first of all, a bit of history. Now, bread, you probably not need me to tell you, is something that has been around for a very long time. It's a real staple food. It's existed for thousands of years. And so what you get over time is you go from something that was originally very much made in the household to eventually something that in the medieval and early modern period starts becoming more commercial. You get people selling bread much more in the way that we might think of it now. And then it's really in the 20th century that we get what we're interested in terms of the pre-seen and the industry, which is where you get the mass production of bread, where things are much more, it's manufacturing, it's sometimes much more than baking. And what happens is in the 20th century you get developments in bread, in the ways that you can make bread. For example, the Chorleywood bread process, which enables fast production of bread. It enables you to make bread that's got a longer shelf life, and that suddenly means that you can go from bread making being a small thing that happens in bakeries to something that is much quicker, much cheaper, and therefore that can be mass produced. And that is why now you just go to the supermarket and you get shelf after shelf of packaged slice loaves, because of that development and progress that happened mostly within the 20th century. Well, what we then get in the last few decades, which is interesting, and this is very relevant to some of the stuff we see in the pre-scene, is this shift towards different options. So people start becoming a little bit more skeptical, a bit more fed up of mass-produced bread. They're wanting stuff that's fresher. They're wanting things that are healthier, perhaps giving more of that sense of homemade artisan. And so there is a bit of a shift back towards the more independent style artisan bakeries. And so in a sense, you kind of had this progress and then a slight reversal back to less efficient ways of making bread, because that's what customers are increasingly wanting. So that's a bit of a history of the bread industry. Let's talk about the industry life cycle of the bread industry. And that kind of maps on to a certain extent onto the history of bread making. Obviously, we've got the initial stage where bread making, the introduction stage where it's a slow process, things take time. We then get increasingly baking becomes a commercial thing. We've mentioned, I think, the Chorleywood bread process, which helps to kickstart the more industrial style baking of bread, where you can mass produce bread, you can bake it in very efficient, consistent ways. And so what we get then really is the maturity stage, which is very much matches on to those developments we see in the 20th century, where interestingly you get this maturity stage corresponds to both this incredible progress in efficiency. That's why you just see bread everywhere. You go to the supermarket, it's absolutely you get aisles that are packed full of prepackaged bread. But that goes hand in hand also with a greater emphasis on having breads that are healthier, having breads that feel like they're a bit more homemade. And then also another thing to throw in there is the growth in wanting to see sustainability, both in terms of the ingredients that are being used, but also in terms of environmental concerns. So things like packaging and so on. There's a reaction against the more plastic style packaging. So you get this maturity stage really in the 20th century. And so the question is really, do we then have a decline stage to the bread industry? And I think the answer is maybe it's more of a reinvention. Maybe it's not so much a decline, because at the end of the day, bread is a staple. It's probably going to continue to be a staple. But what we've got is that the classic white sandwich bread, which is probably the most widespread style of sliced packaged bread, is not as popular as it used to be. And instead what we're getting is again that increasing emphasis on better quality, more healthy options, and then also fewer artificial ingredients. And that seems to be what various bakeries are responding to, whether that's by releasing high protein loaves, for example, using eco-friendly packaging, or new baking tech.
The next clip is taken from one of our most popular videos, the Top 10 Issues. The Top 10 Issues video identifies the 10 most likely issues to appear in the exam based on our expertise and experience in this area. And our expert gives guidance on how to deal with the issues in your answers, provides advice on which models to use, and key points that you should raise. Based on our experience of analysing CIMA case studies for over 10 years, our predictions have been extremely accurate in previous exams, with around 70 to 80% of topics in the real exams being covered in our top 10 lists. So take a look now at this clip from our top 10 issues video.
So let's jump in, and we're going to start with 10 to 6. So let's jump into the first, issue number 10 that we think could come up. And that is going to be financial reporting. Financial reporting. Why have we chosen this? Well, the basis of choice is This is a key F1 syllabus area. That is a very large chunk of F1, which you will have done in preparation for this exam. It's also always examined. You will be very hard pressed to find any variation of an OCS exam that does not involve some kind of financial reporting. So it is pretty much always examined. So you can almost guarantee that it comes up. Another reason particularly relevant to the pre-scene is that there has recently been a large investment in PPE, and knowing your standards with PPE and how you are meant to approach measuring, disclosures, valuation, and so on with PPE is something you will need to know. And so it's quite likely that that is going to be assessed. And we've also got some leases on the balance sheet, and you need to know IFRS 16 leases. That's part of your F1 syllabus. And so it's basically almost impossible that this is not going to come up. So bearing that in mind, what are some likely issues that we might end up seeing related to financial reporting? Well, here are a few. I think asset purchase and disposal, I think, is going to be quite a likely issue. So buying assets, buying machinery, disposing of those. We've seen both of those happen in the pre-scene, so that makes it immediately more likely. Machinery upgrades. This is a machinery heavy business, and so again we might have some machinery upgrades that then need to be thought through in terms of their implications for financial reporting. Again, you're drawing on IAS 16 with plant, property and equipment. Leasing machinery, that's probably something that's likely to come up as well. Halfpenny have got a delivery fleet. Again, that's going to be something that we might need to think through the financial reporting implications of that. Inventory is a big deal, quite quick turnover of inventory, but how do you go about doing inventory valuation? And then impact of tax on financial statements. So thinking through things like capital allowance and so on, and the impact that would then have on the taxable profit and ultimately tax in the financial statement. So those are some likely issues that we think are going to arise when it comes to financial reporting. What are some key points you might want to raise? Well, you will need to apply the relevant standard. So in a sense, it depends what the question is as to what standard you are going to draw on. So make sure you know the ones that you have had to cover in F1, make sure you're familiar with them, and make sure you're able to apply them to different situations. You're going to need to make sure that you note the impact on financial statements. So if you get anything that is related to valuation or sale, disposal or acquisition of machinery, and you are asked a question to do with financial reporting, think through what is the impact on financial statements. How does it impact the statement of profit or loss? How does it impact the statement of financial position, statement of cash flows? Make sure you note the impact of financial statements. And make sure that you balance your debits and your credits. Get those debits and credits right when you are dealing with financial reporting. So you've got the acronym DED CLICK that can help you if you remember DED. So debit increases expenses, assets and drawings, and then CLICK, credit increases liabilities, income and capital. So make sure you get your debits and your credits right. And then the relevant theory, well, essentially everything that you've covered in F1 in terms of standards. You're going to need obviously IAS 16, property, plant and equipment, IFRS 5, particularly for disposals or assets that are held for sale, IFRS 16 leases, IAS 2 inventory. Make sure you're familiar with capital allowances on assets, so tax, and then tax depreciation versus accounting depreciation, and making sure that you are applying tax depreciation when it comes to capital allowance. IAS 10, events after the reporting period. So there's some of the theory that you will need to draw on for that particular issue. Moving on. Issue number 9 that we would suggest is very likely to come up is going to be variance analysis. Now, why is that? Well, the reason is it's very frequently examined. It's one of the most commonly examined topics, and it's an incredibly important P1 topic. So whether or not there was anything in the pre-scene that would lead us to believe that variance analysis was examined, it's generally very frequently examined. But we also have some very clear budget information and a cost card in the pre-scene that suggests you're going to likely have to do some variance analysis. So let's think through what are some likely issues that could come up to do with variance analysis? Well, you might need to analyze sales volume and price variances to figure out the impact on revenue that those variances are having. It may be that you need to investigate direct material and labor variances and see how that affects the cost of sales. So maybe raw materials have been more expensive than they thought. That's going to affect the cost of sales. You might need to investigate that, or whether labor is being inefficient. You're also going to have to identify the causes of variances. So you might have a variance, but that doesn't necessarily tell you exactly what's going on. It could be that there's underperformance, or it could be actually that there's just difficult market conditions. And so it's not so much underperforming as the market is difficult, so that leads to a variance. Or it could be that there are some inefficiencies at some point in in the case of Halfpenny, maybe in the production chain or even the distribution chain. So very likely that these are some things that you are going to need to cover. Now, bearing that in mind, what are some key points that you might want to raise to do with variance analysis? Well, it depends on the specific question, the specific task you are being asked. But some things to bear in mind is sales variances, for example. Well, that could be linked to lower sales volume, or it could be to do with pricing pressures in the market. So again, don't assume, but you will need to mention the fact that a sales variance is not necessarily always linked with lower sales volumes. It could be linked with pricing pressures in the market. So though that might be one thing you might want to raise in the exam. Another thing you might need to raise is that cost variances could be down to a number of things. It could be higher material costs, perhaps quite likely in Halfpenny's industry. Labour inefficiencies, perhaps slightly less likely because labour doesn't take up a huge amount of the cost. Or it could be that there's a supply chain issue going on, maybe some inefficiency in the supply chain. Those might be some things to consider. Fixed overhead variances. Well, this is, I think, quite likely to be something that comes up because there are very high fixed overheads when it comes to Halfpenny's manufacturing, Halfpenny's production. So in this case, you might need to consider and raise things like operational inefficiencies in the manufacturing process. That could be leading to higher fixed overheads than had been thought. And so there are some key points that you might need to raise in your answers in the exam. Now, relevant theory when it comes to variance analysis, obviously you're going to need to know your theory from P1, specifically material price and usage variances, labour rate and efficiency variances, fixed overhead expenditure, volume, capacity, efficiency variances, sales price and volume variances, and then also forecasting. So there are some particular sections within that P1 syllabus that you're going to need to make sure that you know in order to be able to answer these questions on variance analysis as effectively as possible.
Our final clip is from our mini mock debrief video. We produce a range of mock exams for each sitting, and alongside each of those mocks is a video debrief. And in these debrief videos, our experienced tutor analyzes every question and takes you through a step-by-step guide on the best way to approach them. And by watching debrief videos, you'll learn to understand how to pick out all of the key information in the task and the requirements. You'll use that information to build an effective plan. Many students fail due to poor answer planning. And then that will help you to formulate an excellent answer. So in our sample video, the tutor will take you through question 1 of the mini mock.
That said, let's jump in and let's have a look through the material here. And the first thing we're going to do, so we've got 2 tasks here. In a normal exam, in a full mock and a full exam, you would have 4 tasks, but we've just halved that to do this slightly shorter mock. The first thing we're going to do is we jump into task 1. And rather than reading through all of this information just yet, we are going to go straight down and have a look at the allocation of time and marks to do with the different subtasks in task 1. That's going to help us when it comes to time management and when it comes to figuring out how much time and energy we should give to each of these tasks. So we know that a task takes 45 minutes. You've got 45 minutes allocated to it. We know that it's worth 25 points. So you can then break down based on these percentages that you have here for each of these subtasks. You can allocate a particular number of marks to each of those tasks and a particular time that you are going to be able to spend on that. So for this first subtask, for subtask A, 32% of those 25 marks is going to be 8 marks. A quick way of doing this, because we're talking about 25 marks in total, you can just take this percentage basically and divide it by 4 as a quick way of getting the number of marks. And that in terms of time, that translates into about 14 minutes. You take about 32% of those 45 minutes gives you around about 14 minutes. The same is true. So subtask A, 36% gives you 9 marks, 16 minutes. Subtask C, 8 marks, 15 minutes. Now, you notice that we've got slightly more minutes for that final task. That's just because obviously when you actually figure out how long you can take on each task, you round it to the closest minute. So we've allowed ourselves an extra minute compared to task A there, but it just gives you a general idea, and it means you can then plan how long you're going to spend on each of those. So let's jump in with subtask A. So we're going to read this particular requirement carefully for this subtask, looking at some of the key words that are used. So we are being asked to write a report that covers the following. We are going to be needing to assess. Now, assess means there's going to have to be some kind of weighing up of whether something is good, whether something is bad. So that just helps you understand. You're not just explaining, you're not just describing, you are assessing. And what do we need to assess? We need to assess the advantages and disadvantages. So that immediately gives you a sense of how you might end up structuring your answer. You've got 2 sides of what you're going to be assessing: advantages, disadvantages of adopting a participative approach to budgeting at Halfpenny. So we know we're going to be talking about budgeting, a participative approach particularly, and we're talking about advantages and disadvantages. So immediately you might go back to your knowledge of the syllabus without even reading any more information. We can think of particular advantages and disadvantages to a participative approach to budgeting. So you're already thinking of how you're going to structure your answer, some possible content to that. And then finally, we need to explain whether or not it would be suitable. So based on that, we've already got a pretty clear sense of the structure of our answer. So basically we can structure our answer around what the subtask is asking us to do. We'll have a section on the advantages of a participative approach, disadvantages, and then thirdly, we're going to apply that to Halfpenny and explain whether the participative approach would be suitable. Make sure you remember to do each of those, because if you forget to do one part of that structure, you're not fully answering the question. So now that we've figured out what we need to do, we've probably already got some ideas of some advantages and disadvantages in our mind, just based on our knowledge of the curriculum. Let's now have a bit of a look at the actual content here. So you really want to have a general sense of what the requirement is before you start looking at the content. And the idea is that you are coming into work, you switch on your computer and you find the following email from your manager. You are a finance officer. This is the finance manager. And it's going to be about budgeting and new product development. So we find out that the manager has been looking at our budgeting approach. Now, just to remind you, if you can't remember from the pre-scene, the budgeting approach of Halfpenny is currently an incremental approach. And so that's probably why they're thinking of reviewing it. There are some concerns about discrepancies between actual and budgeted figures. And there's some reference material. We'll head over to look at that in a second. They've used the same budgeting approach for years, and there's been a lot of changes, but they haven't changed their budgeting approach. So Evita Gomez is wondering about whether to review the current budgeting approach and assess whether it's still the best option. Okay, so the last thing we have to do here before we're going to start actually answering this question is to go and have a look at the reference material. So let's go straight over there and just have a quick look at this. Well, what we've got here are the budgeted and actual sales figures for the previous year. As you can see, sales revenue, the budgeted amount is substantially higher than the actual amount. But then the cost of sales that was budgeted is actually lower than the actual amount. So as a result, what we've got is a gross profit that is quite a bit lower than was actually budgeted for, which is not great. Now, you've got some notes here that give you actual percentages. So actual revenue is almost 2% lower. The cost of sales is actually 3%, pretty much 3% higher than anticipated. That is a major fall in gross profit, 12.93% compared to what was actually what actually happened, compared to what was predicted. And there are some clear variances that suggest that Halfpenny might need to reassess its budgeting process. So there we go. We've had a look at the reference material. We've gleaned what we might need from that. And so what we're now going to do is go over and think through how we would produce an answer based on that. Okay, so here is where we are going to plan our answers. So let's have a look first of all, obviously at task 1. We're in task 1, and we're just going to repeat here the 3 different subtasks and the allocation of marks and minutes. So let's jump in to the first of those, which we've just been doing a little bit of thinking about. So the question on participative budgeting. Now within that, we've got 14 minutes, so we can allocate around about 2.5 minutes to actually planning. So let's go ahead and let's come up with a plan based on what we have suggested so far. So what we're going to do is, first of all, we're going to define what participative budgeting is. So that could be done in the introduction to our answer. We're going to say it's about employees across different departments and levels of the organization being involved in preparing budgets. And then we've got the first major part of our answer, which is looking at the advantages. We're going to suggest that participative budgeting can improve accuracy because the different departments will basically generally have a better idea about the actual costs to their department than the company directors. And so a participative budgeting can really improve accuracy. It also increases ownership and motivation. So different departments get to set their budgets. They get a say in the budget. That automatically means they're going to have a stronger sense of ownership of that budget. And it also means there's going to be better cross-departmental communication. The idea there is that because all of the departments are involved in creating the budget, they're going to have to be communicating their preferences to the directors, potentially also the different departments. And so it's going to increase and make communication a bit better. But we also need to look at the disadvantages, and we're going to suggest some disadvantages. Now, these are things that you should probably just know from your syllabus knowledge. You don't necessarily have to be really aware of the pre-seen information to get this. But one disadvantage is the fact that it's time consuming and complex. It obviously takes a lot longer than just the directors setting the budget and imposing it. There's also the potential for budgetary slack, which is the idea that different departments could decide to maybe make predicted revenue slightly easier. So they might lower predicted revenue less than is realistic so that it's easier for them to hit, for example. So that's called budgetary slack. And also it could cause conflict between different departments because different departments might want slightly different things. And at the end of the day, there's only a limited amount of resources to go around the whole company. And so different departments might want certain amount of resources, and they might not be able to get that. And that could lead to conflict between departments, which is never something that you really want to get. But we don't just have to look at advantages and disadvantages, we also need to apply that to Halfpenny. So we're going to think about the suitability of that model to Halfpenny. Well, we're going to mention that it could help with cost control, and cost control is very important with Halfpenny and those quite low margins of profit. But we're also going to say that we do need to think through the disadvantages. And actually, a business like Halfpenny, where efficiency is so important, means that any lack of efficiency that participative budgeting could lead to is actually potentially going to be a big deal. So what we might actually suggest is that because there's advantages and disadvantages, maybe a hybrid approach might actually be preferable, where there's both input from the different departments, but at the end of the day, there is also the top-down side of budgeting from the directors. So there is a possible way that you could plan an answer to to subtask A, and then that should leave you with about 11.5 minutes to actually write your answer.
So there we have it, 5 key videos to get you started with your exam preparation. I hope you found them useful, but the reality is that this is just the starting point, and you'll need to do a lot more preparation over the next few weeks to improve your chances of passing this tricky exam. And to that end, we have a number of options available. The video clips you've just seen are taken from our course content. And our courses are designed to help you ultimately pass the exam. We want to minimize your study time. And of course, we want to ensure that you're getting your value for your money. So if you want more of what you saw today, you want to check out our full pre-scene analysis pack. And that basically includes the full videos from which those clips were taken. From the pre-scene analysis videos through to the top 10 analysis, the strategic analysis, industry analysis, and in addition to that, we've also got 30 pre-scene questions that are designed to help you consolidate your knowledge and understanding of the pre-scene company. Pre-scene analysis is a crucial first step, but passing the exam requires developing your exam technique and lots of practice. So the best all-round comprehensive solution is the Astranti Premium course. On that, in addition to everything you get in the pre-scene analysis pack, you'll also get 5 mock exams. And those mock exams are written according to the pre-scene company. They're not generic and they don't have generic solutions. They're applied to the pre-scene and they're based on the top 10 issues. So you'll get questions in the mock exam that they'll have a good chance of coming up in the real exam. In addition to those mock exams, you can get mock marking and feedback. And this is where you'll submit a mock exam to your dedicated marker and they will mark that and give you a fully annotated script with feedback and annotations. And they also provide a 9-page document with feedback that you can apply in your next mock. In addition to that, we've got our exam technique video series. Exam technique is really important in this exam. And so our exam technique video series has 13 chapter study texts and accompanying videos taking you through every aspect of exam technique, right from understanding the exam through to interpreting the requirements, answer planning, writing technique, and time management. Really valuable course that will help you a lot developing those soft skills that you need to do well in this exam. Alongside that, we have 3 live masterclasses that run throughout the course, from the first one that's looking at the pre-scene through to later ones that look more at exam technique and theory revision to help you get ready. Included in the premium, you get access to tutor and mentor support, and you'll be able to access our discussion hub where you can post your questions and talk with other students and tutors about any questions and queries you may have. And our premium course comes with our double pass guarantee, and that's exclusive to premium course students. It's a double guarantee because if you don't pass, if you take this course and you don't pass the exam, we'll give it you again for free with no extra charge. And you also have a 14-day money-back guarantee. So if after 14 days on the course you're not happy, you can get a refund, no questions asked. So whatever your situation, we believe we have the solution for you at Astranti, and you can find out more at astranti.com/CIMA. Thanks for watching.